We are still in pre-market, and every time I'm hitting refresh, the stock price of Crocs is going up. I don't know how much it will go up today. I don't know how much money I will make. But one thing I know for sure is that Crocs is going to be the largest position in my portfolio as from today. Let's have a look at these earnings. To be frank with you, there is nothing crazy the first time I look at these earnings. There was nothing unexpected with it. It's just that the market was so bearish on Crocs that now Mr. Market seems surprised with his numbers. Crocs revenues grew by 3.1%, 3.8% constant currency. You see, there's nothing crazy in that. It's what everyone was expecting except Mr. Market. But one thing that I like on these earnings is, hey dude, the margins of hey dude actually improved and the revenues were expected to go down, but they were flat. Of course, this is nowhere near the margins of the Crocs brand, and over the long term, if really hey dude is to succeed, we expect that the margins are going to come closer to the Crocs brand. As I mentioned on Monday in my last video about Crocs, is that it was something I was going to follow. What is happening with hey dude, and if there's stabilization, it's a good news. And one thing I like about those earnings is that the predictions for 2025 are nothing crazy. They are not saying that they are going to have double-digit growth. They still expect the revenues of hey dude to go down 7%, and they still expect that the revenues of Crocs overall, the whole company, I think it's 2.5% they put. So it's a very small number. It's better to have your expectations low and then to be positively surprised instead of negatively surprised. And it's over the whole year, the capital expenditures of Crocs were only $69 million US, about the same as depreciation and amortization. This is a company that requires little capital to operate. Yes, they are not growing that much today. It's because it's cyclical. There are trends, it's fashion, it's always like this. But nevertheless, this company today, this year, it required only $69 million in capital expenditures in order to make nearly $1 billion in cash flows. This is amazing. There are only a few companies in the world able to do such things. And this is a shoe company. It's not Apple, it's a shoe company. And in a few minutes, I will tell you why they are able to do such things. Next, let's talk about share repurchases, capital allocation. One more thing I said was important to look at. The company has been very opportunistic with buybacks. Of course, this year share buybacks were only around 5% of total shares. Now that they have added a new program of $1 billion repurchase, the total to be repurchased is around $1.3 billion, which is 20% of the company. This is a lot. They have not said when they are going to buy that. I don't think it's going to be next year because the company does not generate that much cash, but maybe over the next 3-5 years, which is still good. You can expect that the number of shares outstanding of Crocs, if the stock price remains around this price, will go down by 5% every year. So even if, let's say, earnings are constant, the earnings per share is increasing by 5%. And the intrinsic value per share is increasing by 5%, even if nothing happens. And the company is also repaying its debt. So even if the same earnings, the fact that over the long term the debt is going down means more earnings to the owners of the company. I'm going to do a full analysis maybe tomorrow about this company, about the intrinsic value, but it doesn't really matter. What matters now today is at this price, Crocs is still massively undervalued according to me. And when you have such an opportunity in the market, it's rare, it's better to go big. What is so special about Crocs? I talk about this on a post on eToro today that Warren Buffett wrote in the 1991 letter to shareholders, that you need to look at your portfolio as a company, as a holding company. Let's say you're the CEO, the CFO of that holding company. You want to do the best capital allocation. And you put your money in places where there is high return on capital. Crocs is such a company. They need little capital to make a lot of money because they have been able to delegate the task of making shoes to third parties. And they are able to sell the shoes at a premium because of the strong brand. This is a company with negative tangible book value. Nothing wrong with that, as long as they are generating the cash. And it doesn't matter that you're down on a position. You should focus on the fundamentals. And in the case of Crocs, the fundamentals are here. And they have improved, they are going to improve. Hopefully they will keep improving over the long term. This reminds me so much about GameStop in 2020, 2019 when I invested in the company. I was down 60%, but I did not cry. I invested more. Even though I made 150%, in a month on GameStop. I made 3,000% on the investment. If I could go back in the past and give myself one advice on how to do it better, it would not be to invest when the stock price was at its lowest, because I don't want to go into the past and tell myself how to time the market. I don't want to do that. The advice would be go bigger. At some point, it was 8% of my portfolio. That's when I stopped buying. I should have gone bigger. Of course, GameStop is a once-in-a-lifetime trade. We are not going to have this again. And if you missed the video, I would recommend you watch it next. Have a nice day and goodbye.